people's perception, this uncertainty of what's going on in the economy, what they're reading about, whether it be tariffs or other things, usually causes them concern, and so they start to tighten. So we're seeing a reduction in spending by a majority of the consumers, our members. So we're feeling that. Of course, all those folks, most of being a low-income designated credit union, we serve, low to mod folks, and all those folks are looking for ways to improve their cash flows. So great deal of lending is going on with regards to consolidation loans, finding ways to potentially package that and improve people's credit so that they might lower the interest rate that they're paying at the moment.
Mm-hmm.
So,
John, question?
So, as you well know, the banking industry has often argued that they've got a hand tied behind their back because their income is taxed, their property is taxed, credit unions are not. As has happened before, there's a bill filed in Congress that would tax credit union income. I think of credit unions with $1 billion in assets or higher.
that's right.
I'm going to go out on a limb and assume maybe you're not a big fan of this legislation.
Hard to make
why.
that guess, right? Well, we're not. I do think there's some distinction. I was a 25-year banker prior to finding the credit union space, and I do think there's some distinctions between the two with regards to mission. Us, being a low-income designated, like I mentioned earlier, we're out there to serve people that perhaps banks have different ways of making monies and are less involved on the consumer side of things. I understand their complaint about having their one hand tied behind their back, but we pay all taxes but income tax. Mm-hmm. And my story to them might be, if it's so good, come be a credit union.
How do you think they'd respond to that?
Well, I don't think they'd like it. It's hard to make a living as a credit union, honestly, just because of the limitations with regards to how you can lend money. So our loan portfolio is far different than most banks. We generate income differently, and then of course our access to capital is really what we created earnings. We were one of the first credit unions to go to the sub-debt market in the country, and were the very first to get a bond rating when we did so. And so it's a little bit more prevalent, but it's just not as easy to go find capital as banks have, because they have shares and things of that nature.
Joey?
With demographics changing in the U.S. and the aging of the population, how are you taking that into account with respect to perhaps different spending patterns among the elderly population, different wealth levels, and so forth? So how do you think about the next 5 to 10 years given that demographic shift that we're seeing?
Yeah, I think that contributes to really what's going on in the whole technology arena, right? So everybody, our generations, younger generations, all want a seamless interaction, speed to transaction, comfort, do it on their time frame. And so we, like everybody else, are trying to find the best ways to create that experience. Much of it, digitally and online. People still want to have the ability to access you, in a face-to-face arena. But so the next 5 to 10 years, I think, is that. It's so how do you create the revenues that then allow you to invest in that technology that makes you more relevant with all generations, with how they want to do business with financial services companies, and then how do you keep the talent to do so?